Hi, this is your interest rate watch for Wednesday, October the 13th. Two key points that we want to point out today. First, the Federal Reserve minutes came out yesterday, and with meeting the market expectations, it led to several comments that quantitative easing is going to happen, and we're most likely going to see that in the upcoming November 2nd and 3rd meeting of the Federal Reserve Board. Now, what does this really mean? Right now, as we're looking at the bond page and we're looking at the stock market obviously benefiting above 11,000 now. You know, you have JP Diamond from Chase commenting that they're having one of their strongest earnings. You have Intel with positive earnings. So from the corporate sector, again, we're seeing positive signs of growth in as far as the corporate sector. Now, going to the homeowners, what does this really mean? Well, unfortunately, for the last 3 days, we've been beaten up on the bond market, and for mortgage rates, we're slowly starting to see that climb up. It is short term because the big thing is what will be announced? What type of dollar amounts will the Federal Reserve actually come out with, and how will that impact interest rates? We still feel that interest rates will be pressured lower. Now, the other reason for that is because when we hear from our wholesale lenders, from our correspondent lenders that we're working with, the biggest thing that we are hearing from them when they go to their meetings or economic summits is that their top analysts are saying that they're predicting interest rates to move into the high 3 range, maybe even possibly the mid 3 range. So for a 30-year fixed, who knows? That is all still a gamble because we've said this before. Last year it barely happened. We did get to 4% and then that was it. It was there and gone, never really came back. This year we've seen it many times and now being pressured lower. The key thing here with point 2 is it's all about taking advantage of the market. We're going to call it quote-unquote cheap money for now. And what we mean by that is even if you refinance in the last 2 years, you went from 5% to let's say 4.75, or you went from the high 5s, high 6s, whatever your rate was, you got into the high 4s, and now you're looking at another opportunity to possibly reduce your interest rate by another 1 full percent. People always ask the question, Keith, what happens if, with the payments that I've made over the last 2 years? Well, if you're really looking at amortization schedule, and what that means is a payment schedule for a 30-year fixed mortgage, what's unfortunate, and this is just the brutal reality of a mortgage, for the first 5 years, you're basically paying a majority of your monthly payment on a fixed-rate mortgage towards interest. So even though you have made some payments, you really haven't made too much of a principal reduction. Now, when you really look at the savings that you're going to have of saving by 1% or more by refinancing and take advantage of these new rates that are about to appear after the Federal Reserve meeting or prior to, the big thing is when you calculate how much you've actually paid toward principal, look at your break-even point on closing costs of being probably 2 years or less on most people's cases, then really when you're looking at your overall financial savings, there is a huge benefit there because the key thing, depending on your independent goals, not the national goals, not the market goals, not Washington State goals, your own independent goals as a homeowner, it does make sense in most cases to take advantage of a refinance. Now, we also want to talk about national averages, national statistics, everything going on nationally. Well, that's all fine and dandy if you live and breathe and work like a national human being. I don't know if that's even possible. The big thing is it all comes down to independent goals. And for a lot of people right now, even for families, for buy-ups, for newly married couples, for people who are having changes in their lifestyles, people having opportunities in employment, if in the short term you're thinking about buying real estate or having to buy up in a different home because of more space, an opportunity, then if you're looking at the ARMs, again here, these are not negative amortization loans. These aren't the hard prepayment penalties loans. This is traditional 3, 5, 7, 10-year ARMs. Let's just stick with the 5 and 7 for now. Those interest rates are starting to tip below 3% and showing signs of going there. Now, why do we say that? If your independent goals definitely do match of being able to move in the short-term future, it does make sense to take advantage of the cheap money. Now, we're definitely not making the recommendation if you have long-term goals to take advantage of an ARM just because rates are low. That doesn't make sense. Even if it helps you financially, there is the unfortunate upside of inflation that's going to push interest rates higher, and if your goals didn't match the type of financing you're in, you're putting yourself at grave risk as far as shocking payments of what that could do. On the flip side, if your goals match, it does make sense. So we don't want to totally tell the market and how they've done in the media, arms are dangerous, arms are dangerous. They are dangerous if they're not properly planned with the right goals in mind. We definitely would never make the recommendation if someone called in and said, I'm going to be here at least 10 years or more. What do you think? well, we're going to automatically go to a 30-year fixed mortgage or 15-year fixed mortgage. However, if their goals were, I'm going to have this opportunity change, I'm a resident doctor, I'm in residency, I'm going to come out of residency in the next 2 years, I'm going to have a change in income, a change in lifestyle, well then maybe, just maybe, we would present those options to say, here are two different options. You have the potential of changing income, you're going to be buying up, what do you think about the future? In those situations, obviously it makes a lot of financial sense. And that's the one key thing we wanted to point out, because we feel that media hasn't done a proper job of really doing the education here. And that is our definite priority with the market, with the residents of Washington State, and just overall with this whole real estate recovery, is making sure that people still understand there's a lot of opportunities out there, and it just depends on your independent goals, not the national statistics. So we hope you enjoyed today's session. We'll definitely be back tomorrow with any more breaking news. Make sure to follow us on our Facebook and Twitter pages, and we'll talk to you soon.